Reserve is set to make an interest rate announcement this Wednesday. This is all following Friday's non-farm payrolls report, which showed significantly more jobs added to the U.S. economy than expected, and an unemployment rate that sat at 4% for the month of May, a level that's not been seen in about 2.5 years. We have been wondering, out of this data, how this new economic discussion will impact the Fed's rate decision, what new narratives around a hold, a cut, or even a hike might mean for equity and bond investors. Joining me a bit earlier to dive into some of these questions and to share his latest market thesis is Fidelity Director of Global Macro, Jurrien Timmer.
Hello, nice to see you.
Hi, Jurrien. How are you?
I'm well, thank you.
Great to see you. I'm sort of dying to ask you about what you think of all of this. Certainly the number was higher than we thought, and I think the bond market movement out of it was kind of incredible. Looking forward, what ultimately does it mean for the decision itself?
Well, the economy has been, in the U.S., has been quite resilient, as we know. And of course, the Fed, has a bias to ease, right? If you think about the Fed, there's 5 modes, right? It can be neutral with no interest in changing that policy. It could be tightening, it could be cutting, or it can have a bias to ease or a bias to tighten. So right now, the Fed is obviously on hold with a bias to ease. We went from 6 expected rate cuts earlier this year to now basically 0 to 2, and every day you look at the data, it's either closer to 0 or closer to 2. But what few rate cuts are still expected aren't expected until later this year, which is now a new juxtaposition against, of course, the Bank of Canada cutting rates, and we know what just happened out of the ECB as well. And it all spells the same thing, which is that the Fed and other central banks are restrictive. Obviously, the longer you stay restrictive, meaning above neutral, the bigger the risk is that something breaks in the economy. But so far, it hasn't, and that actually begs the question, at least in the U.S., of what actually is the neutral rate, and how far above it is the Fed actually, or is it actually restrictive, And I think that's an ongoing question. We used to think that a neutral rate was like 2.5. My sense is that it's closer to 4, if not higher, which still leaves the Fed some room to cut, but not as much as previously thought. And just the fact that the economy hasn't crumbled under the weight of 5 3/8% Fed funds rate, and the stock market is not, falling apart because it's not getting those rate cuts that it was expecting earlier, I think are all obviously very good signs, but also signs that maybe the new normal is for the neutral rate to be higher, which I think is a good sign. It means that maybe productivity is on the increase, that the economy is actually in better shape than historically has been the case. But it also argues that there's less room on the downside for rates, including the long end, and also that maybe there's less room for inflation to come down, because inflation tends to get tamed by a very restrictive Fed. And if the Fed is somewhat restrictive, but not super restrictive, maybe that makes that last mile of going from 3% to 2% that much harder to attain.
So what role in the last mile does something that you've spoken about for some time now, the fiscal dominance that we live in at this point? To what extent is the fiscal dominance keeping that final mile there and holding it, it appears, so far?
Yeah, for sure. And we can go to slide 6 and show the sad story of the U.S. debt load. And of course, the U.S. is not alone.
It is not alone. We share your sadness. At all.
Yes. And you will notice, if you are paying attention to the political discourse in the U.S., which I try not to do because it's aggravating, but sometimes we don't have a choice. This is not really a partisan thing, right? I mean, both sides of the aisle in Washington like to spend money, no matter what kind of lip service has been provided. But so the U.S., of course, has a large deficit. And it is persistent, and it is likely to continue for as far as the eye can see. And of course, the question, if we go to slide 7, is how much of this debt can be financed at low rates. And can that happen when the Fed and other central banks are not sort of the buyer of first or last resort, right? I mean, the People's Bank of China is not buying treasuries. The Bank of Japan has to intervene to prop up its own currency. So that means it's not, if anything, it's selling dollars and selling treasuries. And of course, the Fed is on a buyer strike as well, although that may not continue forever. But the fiscal dominance, I think, will keep inflation higher than what it otherwise would be. And I think the Fed, I don't know this for sure, but my hunch is that the Fed is aware of its past policy mistakes, especially of the 1960s when it leaned too easy while we had persistent deficits back then as well, that this time around it's going to maintain a tighter policy, almost kind of to lean into or lean against the wind of fiscal dominance. And, this has produced a unique situation in the US dollar because monetary and fiscal policy have been on the opposite sides of the spectrum, if you will, and that's keeping the dollar bid, which, if you look at Japan, that's not the case with the yen, right? Because their fiscal dominance is being, the central bank is playing a subordinate role within a fiscal dominance situation, and you see what's happened to the currency there. So it's an interesting nuance, and we'll see. Right now, ECB, of course, Bank of Canada, starting a cutting cycle, while the Fed probably will stay on hold for a while longer. That should keep the dollar bid, but again, I think it deals with the inflation narrative and the ability for the Fed to cut rates as quickly as maybe it would have done in the past, and for the bond yield to come down. To me, 5% on the 10-year is more likely than 4%, and we're at like 4.45 right now. But so that will be, I think, an ongoing dynamic. And just from the bigger picture story, and we've talked about this, in the past, and we'll go to slide 8, is, the last couple of decades, we're used to a regime until the pandemic where you would have occasional deflationary shocks in the system. Stock market would go down, fears of deflation, of recession would rise, and bond yields would fall. And it was falling bond yields that were kind of the thing that was to be feared. And bonds were a port in the storm for when a shock happened to the stock market. But now, but in the past, if you look at this chart, you look at the term premium going back in the 80s and the 70s and the 60s, back then, bonds were positively correlated to stocks, and they were actually the source of the volatility for stocks often, right?
Because and they are now, too. Yeah. I mean, that's where the vol is.
Exactly. So I think we're back to an era where bonds are the center of gravity and more likely to be the source of the storm rather than the port in the storm. And that all deals also with the fiscal dominance. But, again, that's not to say that bonds don't play a role. I mean, they have a good income, but they're a different animal than they used to be. And for all of us operating in the 60-40 paradigm, it's important to know what drives what and how. And I think that's kind of how we have to construct a portfolio around that.
Okay, well, let's go into the strategic sort of allocation, the discussion of how to construct a portfolio, or at least a worldview, depending on how people are investing. That's the story for bonds. We've heard, even high yield bonds, again, are pumping out attractive yields, obviously, for those that want to be invested in them. Again, it's sort of a different beast situation. It seems like that could go on for some time. So how do you put it together? You've been talking about alts for some time, the last several months. Kind of put it together for us, or draw the painting for us, sketch it for us. Yeah.
Yeah, so let's go to slide 24, and I'll show you kind of the risk return dynamic that have been in place for the last 75 years, actually. And what you see here is, volatility on the horizontal axis, the return, annualized return on the vertical, and then that line that you see is, it's my version of the efficient frontier. And of course, in a perfect world, we would find assets that would be in the upper left corner, right, where you're getting a lot more return for less risk. But as you see, there's nothing in that corner.
No, there's nothing.
So there's no free lunch, right? And so, but structurally speaking, over the very, very long term, you see how well equities do. You see that bonds do okay, right? They have less volatility, less return, but they've produced higher than the inflation rate or more than the inflation rate, which of course is what we want ultimately. And you can see as well over the very long term that commodities are not really a good place to invest because almost by definition, over the very long term, they generate the inflation rate. I mean, commodities are part of the inflation, formula,
Right.
but they require a lot of volatility. So you get very little return for a lot of volatility. But there are times when they work, and I think we're actually in one of those times. But if we go to the next slide, we can see kind of the changing correlation. So on the left, I show Sharpe ratios, and we can see the 60-40 doing well, obviously equities and other assets. And on the right, I show the correlation to the S&P 500. And bonds used to be at the very top, meaning they were negatively correlated. And now they are positively correlated. That changed in 2022, and I think that that will continue. And so now actually the US dollar, which is not really an asset class, so it depends on how you manifest an exposure to the US dollar, but the US dollar is sharply negatively correlated. And so for a Canadian investor, of course, that's very interesting because
Absolutely.
it shows you that there's a way to navigate, the risk of an equity portfolio. But if you look right below the USD there, you see cash, macro, CTA, so that's managed futures, absolute return, hedged equity. They all have basically zero correlations. And they have decent returns, and gold is in there. Bitcoin has a positive correlation, but it has come down. So if we now take this a step further and go to the next slide, I'll show you what this risk-reward trade-off looked like during the era of negative correlation. So this is from 1998 to 2020. And you can see on the left side, those empty circles there. The empty circle means that the correlation is negative. And you see, equities doing well, but you see how well bonds did. They were above the line and they had a negative correlation. So you had your cake and could eat it too, basically. But now, when we look at sort of the post-pandemic era, if we go to the next slide, you will see that that has changed. Bonds are now at the bottom. Not only are they positively correlated, but they have a negative performance. And at the same time, those little dots you see, and the smaller the dot, the less correlated the asset class is. So that's why the dots are small. You see there LS, long short, CTA, which are commodity trading advisors or managed futures, hedge funds, macro, which are another category of hedge funds. They have sort of replaced what bonds used to offer, not with a negative correlation, but at least a non-correlation. And that takes us a little bit, so that gives us one area
Right.
where we can diversify in a 60-40. And that's why I call it kind of the 50-30-20. And just for kicks, if we go to the next slide, it's the same chart, but with Bitcoin added. And it just shows you what an alien asset class that is.
It really is, isn't it? Look at it all crowded in.
Yeah. So you have to stretch the scales out pretty dramatically just to fit that thing on the chart. And so the Sharpe ratio is great, but the numerator and the denominator of the Sharpe ratio are very high. So that just means that a little goes a long way if you are interested in adding Bitcoin to that 60-40 model.
And I just loved all in the slide before. Those are the alts, as you say. You're naming them. Some of them were hedge fund instruments, and some aren't. But it's fascinating how that can even the ride out a little bit for investors going forward. Just coming back to the dollar a little bit. I wonder if you can just kind of remind all of us. I think we all kind of intuitively know this, but Canada, for instance, is an exporting nation. So our lower dollar is painful, I think, for all of us to leave the country and to do lots of things with, and it hurts. But it's good for the export story in a relative sense. From the U.S. perspective, you're so self-contained and self-sufficient. I don't know. I was just wondering if you could sort of talk about those dynamics. the relative currency story for investors, for Canadians, is a big deal, but it also doesn't matter much to U.S. investors, is it?
Yeah, that's correct. I mean, policymakers generally do not want a strong currency. And so, but obviously, if it goes off the rails, like it's like what's happened in Japan,
Sure.
too much of a good thing is not a good thing anymore. And so, but nobody wants a strong currency because it decreases your competitiveness, right? And so, obviously, if countries are importing products or services from Canada, for instance, you want to have the currency be competitive and not too strong. Um, and so, but again, it's a matter of extreme. So it's interesting that you asked that because obviously in the political debate, Trump versus Biden, Trump wants a strong dollar, but he wants low rates at the same time. So I don't know how likely that is going to go together. But the dollar is being supported by the fact that the Fed is leaning against the tide of fiscal dominance. If the Fed were to really start cutting rates, whether it's in a recession or just because it feels like it can, or if it becomes subordinate to the government, right? I mean, we have to think about even things like the Fed's independence when we think about the political story going on. If any of those things were to happen, you could imagine that the dollar would weaken, right? And if the loonie trades on a pair against the dollar and the dollar weakens against the euro or the yen, then you all get kind of caught up in that as well. But for now, the dollar remains bid, even though the share of global reserves has been steadily declining over the years. It's only 58% now. It used to be about 65 or so. So it's an interesting phenomena. But part of this, I think, is also capital flows, right? Money flowing into the U.S. I mean, we obviously know the AI and mega cap tech story. So the U.S. attracts capital, right? The economy is strong and real rates are positive. And so what's not to like about that if you're a global investor investing either directly into the U.S. economy or via the stock or bond markets?
I wonder if you can talk a little bit more about sort of the centering piece of bonds. Just coming back to that for a second. I mean, there are those that are worried about where the economy was going to go, or at least up until we got that jobs report in recent days. But bonds was a good place to be ultimately, because if there was a blip of some sort, be it the election, be it anything, that it was you stood to gain quite a lot because yields have been so high. It was going to be quite a capital gain, actually, ultimately. Where does that sit now when we see sort of do we just hold on to that for the future, or has that been erased, or what's the story, would you say?
My sense is that, and maybe we could pull up slide 9 here. There's still a place for bonds, right? They are now positively correlated. That may change or it may not, who knows? But real yields are positive, right? Inflation's running about 3.5. The bond yield's 4.5. So you're getting a positive real yield. But as you see here with the Fed model chart, and the Fed model, it compares the equity PE to the bond PE, or the equity earnings yield to the bond yield. And you can see that until the late 90s, those two series were always in lockstep. And that's where the Fed model comes from, meaning that if yields rise too much and the stock market is ignoring it, eventually the bond market will get the stock market's attention. And that's kind of the mode we've been in since 2022, right? I mean, obviously that year we had a 28% decline amid rising rates, a rising cost of capital. Last fall, we had a 10% correction in the stock market when the 10-year yield went to 5%. And even in recent weeks or the last few months, we've seen a similar story. So the way I think about it is that if we got a recession, the Fed would cut, of course. It would assume that inflation will go down, and recessions tend to do that. But it will cut less than what it would have done when inflation was below target. Back then the Fed could go to like 0, basically. I think that's very unlikely. The Fed might go to 2 or 3, and that creates less downside for yields, but it would argue that yields would go down. So you do probably still get that protection. But the nuance that I would highlight, again, per the Fed model, is that in the old days, before the Great Moderation, it was rising yields that would create the tension in the stock market. And that's been the case now for the last couple of years. And I think that's going to continue. So it's one of these odd things where you don't want to own bonds until you do,
Right.
right? Because
Yeah.
you don't want to own them until the stock market starts to correct, but then you do want to own them. And obviously, that involves a level of market timing that no one
No.
can do. So clearly, you want to own some bonds. And the way I would sort of thread that needle is I would own the 2-year, the 5-year, the intermediate part of the yield curve, the belly of the
The
curve,
belly
as
of the
we
curve.
call it. Maybe some high yield, as you had mentioned, or leveraged loans, or some other pockets of the bond market, but avoiding that ultra long duration, which would do well in a recession for sure, but it's also the thing that might actually cause a recession. So 30-year bonds, 20 years, 10 years, that's where the lack of a term premium, in my view, is an issue. And that's where, in my view, rising yields are going to create a pinch for stocks. But the 5-year, the 2-year, that part doesn't really have a term premium issue because term premiums tend to come in for longer maturities, not shorter ones. And that part of the curve is highly sort of levered, if you will. It has high convexity to the Fed cutting rates, which the Fed would do in a recession. So to me, that's how I would thread the needle. I would own bonds. I would own the belly of the curve and just, assume that you're not going to get the negative correlation, but in a recession, you might get it for a while and then you still get some protection.
Amazing, thank you. Let me ask you on something else that's very long term, sort of the idea of the secular trend that we're sitting in. How easy is it to see secular pieces of the market? Because you have this election coming that could change things. I mean, I think we're getting to the point of the year where we can start to ask these questions, like how well can you see 2025 without knowing the result, for instance?
Yeah, that's a tough one because my work on elections shows that elections can and will make a difference for the stock market over the subsequent 2 years, because obviously policies get in action. I mean, imagine Biden versus Trump and what that means for energy policy, the green transition, things like that. So clearly, it matters to some degree. But over the longer term, over like a 4-year window, when you've now also had a midterm election, which often course corrects a more lopsided presidential election, over 4 years, it doesn't really matter. Like the return for the S&P is virtually the same, no matter who wins or what party controls what, or whether you have gridlock or a sweep. So if you wait long enough, it doesn't really matter. The economy and the stock market are just too big, and the machinery of how the economy works is bigger than policy changes will create at the margin. But you do raise a good question about the structural trend, and maybe we can go to slide 16 here. I've been calling this the 7-in-7 market. I think we're in the seventh inning of a cyclical bull, which would argue that it would end in 25, and then we'd have maybe a recession or rising rates, again, creating that kind of same impulse that we've seen over the last few years. And I also think we're in the seventh inning of the secular trend. So here's the S&P real return going back 150 years or so. And the orange line at the bottom shows the deviation from that trend line. And, we're not as far deviated from the trend line as we've been at past peaks. And if we look at slide 17 for a moment, this just lines up the 3 secular bull markets of the past, at least the way I define it, against the current one. So we have the 1920s, which was short and fast, and it's kind of like Icarus flying too close to the sun. Its wings burned and it self-destructed very quickly, or prematurely, I should say. And then we had the 60s, the 50s and 60s, and we had the 80s and 90s. And you can see that the market's following that pattern pretty closely. And again, the issue with calling secular trends is that, as you can see from this chart, the sample size is extremely small, right? So you cannot make a statistically compelling case that we're in the seventh inning because we have 1,000 other examples, and and so we have three examples. So it's not enough, and even one out of those three doesn't even fit. So that's kind of the shortcoming. But my sense is that if we actually can skip to slide 20, my sense is that we're in the seventh inning. And that this secular trend is maturing. And I think inflation and fiscal dominance and rising term premia are all part of that. And, they won't stop a bull market from happening, but those factors might hold down valuations. And so for every dollar of earnings, you don't get sort of an equal measure of price gain if valuations become a headwind. And the other part of that, of course, is the CAPE model, which I've talked about a number of times, where you look at the trailing long-term valuation, in this case, the 5-year cyclically adjusted price to cash flow ratio, and it tends to have good leading characteristics for future returns. And this shows that we've already surpassed the peak return of 16%. That's a 10-year CAGR, and we're going down towards 7, which is not the end of the world by any means, but it is somewhat below average. And if we take one more look at this on slide 21, I've taken that CAPE model and just created sort of a return level out of that, with the very strong caveat that when you convert a 10-year annualized return into price or total return index, it's going to be much smoother than it will ever be in reality. And also, the CAPE model shows you what the fair value is, not what the actual return will be, which can deviate quite sharply, as it did in the late 90s, as you can see from the gray bars in the top to in the bottom to the orange bars. But what this chart suggests is that in 2026 sometime, we'll transition from above average returns to below average returns, not negative returns, but below average returns. So my sense is that at that point, the fiscal dominance really starts to hit home, and you start getting into issues about how is the government going to fund this? What role will the Fed play? What does that do to its independence? And all of those questions that I'm sure we'll be discussing in the next couple of years.
Absolutely. I look forward to the next webcast to discuss some of those. Anyway, Jurrien Timmer, a pleasure to speak with you. Thank you for straightening us out for the week. We always need that. And wish you a very good week ahead.
Great. Have a great week.